When a stock is kicked out of the index, should you buy it? The latest evidence suggests yes. I'm Jack Otter of Barron's.com. I'm here with Brendan Conway, who writes the Focus on Funds blog. Now, Brendan, I've always known that studies have shown when a stock gets kicked out of the Dow, and I might get in trouble for saying that in this building, it often does better than the stock that replaces it in the index. But those numbers are fairly small. You've got some dramatic numbers in your blog today.
That's right, Jack. And what we're looking at is what happens when you get kicked out of the Nasdaq 100, which is the group of the biggest 100 non-financial stocks on the tech exchange. And the reason I thought of this today was that Netflix is up 24%. That's a stock that has done phenomenally well. What I think is happening here is, and by the way, for the numbers, when you look at the performance, it's quite good. Over the course of a year, something like 40%. You know, when you get kicked out of this index, those stocks as a group do tend to bounce back. If you think about it intuitively, what's going on here is that the reason that they get kicked out of the index is that investors are so sour on these companies, but not all of them are going to go out of business. Oftentimes that opinion is overdone.
But the numbers are just incredible. Instead of an academic study that finds, a few basis points of outperformance, you're talking about 40 and 50%. That's probably not sustainable, but it was fascinating.
Yeah, and keep in mind this is data for just a couple of years.
Good years.
Very good for the market.
Exactly. Yeah. On a different topic, PIMCO recently, or a few years ago, launched a bond ETF that is similar to the PIMCO Total Return Fund, but it's been doing a lot better. I think it's around 10+% return in the past 12 months versus about 7.5% for the mutual fund itself. You say that now PIMCO is coming out with some new ETFs, again based on funds, but they may be worth a look.
Yeah, that's right, Jack. And this fund that they launched, it came out last year, that one. One of the theories about why it performs better is PIMCO Total Return, which is the kind of the classic mutual fund that they offer. It's a $280 billion fund. It's just massive.
It's the largest mutual fund in the world, I believe.
It's giant, exactly. And so the theory is that the ETF is newer, smaller, and it's more nimble, and they can act upon good ideas more easily.
And so now there are these new ETFs, and they're worth a look again by the same theory. They're small and nimble, and maybe Bill Gross and his colleagues can do some magic.
Yeah, it certainly looks like that could be the case. It's not clear when these are going to launch yet, but anytime a company tells you, hey, we just got the green light to make these funds, probably coming soon.
And finally, a quick reminder for investors. It's something we know, but we should be told over and over again. What's the story?
Global markets. People hear this phrase, global. It's supposed to be so good. Sometimes when all of these asset prices are linked together, they do bad things together, which is what happened this week. We saw that the AP's Twitter feed was hacked, causing a 100-point drop in the Dow. Everything fell. It was somewhat frightening for a couple of minutes there.
So it wasn't just the S&P 500 and the Dow, which you would expect to fall on news of a bomb at the White House, but you point out that even the Japanese fund and other international funds fell. So diversity is very important, but it doesn't save you from everything, like we found in 2008 when the only thing that went up was Treasury bonds.
Yeah, at the worst moment, sometimes everything's going to be moving together.
Thanks very much, Brendan.
Thanks, Joe.
And thank you for watching.